Welcome to today's Explainer. We are breaking down what was honestly one of the most explosive trading sessions we've seen on the Korean exchange in a while. The headline is exactly what you see. KOSPI surges plus 4.63%. One signal, two responses. Foreign capital re-enters, institutions hedge. A singular geopolitical catalyst just triggered a massive spike in the market. But, the real story here isn't just the sea of green on the screen. It's actually the completely divergent ways the major players reacted to it. We saw foreign capital rushing in through the front door, while domestic institutions quietly executed this massive hedge out the back. So let's map out exactly how this whole thing played out. 8,123.62. That is exactly where the KOSPI closed. It was an absolute rocket ship of a session, printing an explosive 4.63% spike. And to put that into perspective for a second, when an index as heavy and broad as the KOSPI moves nearly 5% in a single day, that is not just retail noise. That is the undeniable sound of serious institutional money aggressively repositioning itself. Now, you might be wondering, was this just a temporary fake out? Well, the real confirmation of this rally is actually hiding right there in the currency markets. The KOSPI pushed to an intraday high of 8,434. But look at the Korean won. It actually strengthened down to 1522. In the macro world, seeing an equity rally combined with a stronger domestic currency, well, that's the gold standard, right? It proves this wasn't just temporary short covering. This was fresh, foreign capital actively pouring into Korean assets. Okay, so what was the spark that ignited the whole thing? Simply put, it was a massive, sudden evaporation of geopolitical risk. Following reports that a planned strike on Iran was canceled and that a ceasefire was finally in its final stages, that heavy risk premium that had been choking global markets just dissolved overnight. And as you know, when uncertainty clears that rapidly, capital moves incredibly fast. Global markets instantly digested this ceasefire signal. WTI crude cooled off, dropping over 2%. The U.S. 10-year yield fell, and U.S. equities absolutely loved it, with the Dow and Nasdaq both up nicely. But the absolutely crucial metric for Korea? Look at the Philadelphia Semiconductor Index. It surged an incredible 7.91%. That aggressive, tech-heavy momentum is exactly the wave that washed up on Korean shores the very next morning. Let's look at the actual execution on the ground, because here's where it gets wild. We have one macro signal, but two completely different playbooks. Foreign investors re-entered Korean equities with over 2 trillion won, while simultaneously buying over 1 trillion won in futures. So they were directionally aligned, full risk on. But domestic institutions, well, they also bought equities, sure, but their derivative strategy was the exact opposite. They rapidly expanded their short selling. And listen, that institutional short selling wasn't subtle at all. Volume on the KOSDAQ expanded 3.43 times in a single session. That had a 12-month high. Institutions basically instantly replaced foreigners as the dominant short sellers. Why? Well, this is a textbook hedged entry. Institutions were essentially forced to buy the rally so they wouldn't fall behind their benchmarks, but they turned around and immediately bought insurance against a potential drop. Pivoting a bit, underneath that broad index movement, a massive sector narrative completely reset. Reports hit the market that Google is discussing a huge component manufacturing deal with Samsung's foundry unit, specifically for Google's advanced AI chips, using Samsung's cutting-edge 2-nanometer process. Combine a massive deal like that with projections showing hyperscaler spending will quadruple by 2028, you've got the perfect recipe for an explosive tech rally. So here is exactly how the market priced that foundry boom. Samsung Electronics obviously led the charge, rising nearly 8%. But the equipment makers? Oh man, they went absolutely parabolic. HSP and Wonik IPS both slammed right into the daily upper limit of 30%, and they were trading massive volumes. The market aggressively priced in all the secondary equipment demand that this Google deal is going to require. But semiconductors weren't the only story of the day, and this next part brilliantly illustrates how narratives can just shift overnight. A major Goldman Sachs report came out and catalyzed a brand new physical AI premium. The report identified South Korea as a core supply chain nation for humanoid robotics. The structural logic here is actually fascinating. U.S. manufacturers are actively trying to shift their sourcing away from Chinese suppliers. And Korea's existing auto parts and battery infrastructure, it's already qualified as a high-tech alternative. Goldman Sachs basically took that existing substitution logic and slapped it right onto the upcoming humanoid actuator market. And the market wasted zero time reacting to that. Legacy auto part makers were instantly repriced as high-end robotic tech suppliers. HL Mando immediately hit the 30% upper limit, and the entire machinery and equipment sector surged nearly 9%. That is the raw power of a structural narrative shift when it's backed by a major investment bank.
All right, moving to Canary Signal's institutional micro-selection.
You know the saying, a rising tide lifts all boats? Well, not today. While the macro picture looked amazing, the reality at the individual stock level was incredibly nuanced. Let's compare two specific companies, Wonik IPS and Jusung Engineering. Both are major semiconductor equipment stocks, and both are exposed to the exact same foundry boom. Yet Wonik closed at a 30% upper limit, while Jusung actually fell nearly 6%. So, how is that even possible on a day the broader market surged like crazy? Well, the answer is entirely in the institutional flow. Believe it or not, foreign investors actually net sold both of these stocks. The difference was entirely dictated by domestic institutions. For Wonik, institutions stepped in and absorbed all that foreign selling, driving the stock up 30%. But for Jusung, institutions basically joined the foreigners and dumped the stock too. So in this specific pocket of the market, institutions were the ultimate gatekeepers of the rally. So that begs the question, where did all that foreign money actually go? The data reveals a story of absolute hyper-concentration. Out of their entire daily allocation, a staggering 2.49 trillion won was fired directly into the electric and electronics sector. IT services, chemicals, they barely saw a fraction of that. This was a deliberate, highly focused, structural bet on Korean heavy tech. And even within that specific sector, foreign investors made very explicit choices about corporate structure. They wanted direct, unadulterated exposure to the underlying assets. Take a look at the SK Group, for example. Foreigners bought SK Hynix directly, making it the top net buy on the entire KOSPI. But in the exact same session, they aggressively sold SK Square, which is the holding company, making it the top net sell. They bought the direct producer and dumped the holding company proxy, literally surgical capital allocation.
So, to wrap this all up, a market rally is never just one monolithic event, is it? A single geopolitical signal sparked this aggressive foreign re-entry into heavy tech while simultaneously forcing domestic institutions into a massive, heavily hedged balancing act. The surface shows a clean 4.63% surge, but the mechanics reveal a deeply calculated game of chess. And it leaves us with one incredibly important question. If domestic institutions are hedging this heavily right now, what do they know about the global economy that foreign capital might be ignoring? Thank you so much for joining me to break down this incredible session. If you would like to receive news on the closing of Asian stock markets before the New York stock market opens, please make sure to subscribe. See you next time.